Okay, let's just dive right in. For the past couple of years, this term, real-world assets, RWAs, it's gone from just a crypto buzzword to the absolute core of institutional strategy.
It really has. And the scale of the market they're going after it's just mind-boggling.
It almost loses meaning, right? We're talking about bringing something like, what, an estimated $90 trillion of U.S. Treasuries and stocks onto the blockchain?
90 trillion. It's like trying to tokenize the GDP of an entire continent.
Yeah.
This isn't just some trend. It feels more like Wall Street fundamentally rewriting its own plumbing.
Absolutely. And today, for this deep dive, we are unpacking the company that's really at the forefront of that charge, Ondo Finance.
They're a leader, for sure.
Yeah.
They're managing well over $1 billion in tokenized treasuries already, which makes them a true pioneer in this very specific high compliance niche.
Okay, so before we get into the nuts and bolts of how they do it, we have to clarify something the sources kept bringing up. It's a bit confusing, but it's critical. You have Ondo Finance, and then you just have Ondo. What is the difference? Why should we care?
It's all about roles. Ondo Finance is the company, the entity you actually interact with. They do all the heavy lifting, product development, management, and crucially, all the legal compliance. It was founded by, ex-Goldman Sachs people.
Ah, okay, so the corporate entity. And Ondo is the tech, the software.
Exactly. Ondo is just the shorthand for the whole technological ecosystem.
Yeah.
That includes the infrastructure, the lending protocols like Flex Finance, the upcoming Ondo chain, everything.
So Ondo Finance is the builder, and Ondo is the house they're building.
A perfect analogy, yes.
And what they're building is essentially a bridge, connecting that old school, traditional finance TradFi with the speed and efficiency of DeFi. And they're starting with maybe the safest assets on the planet.
U.S. Treasuries. They're combining the security and the regulatory rigor of TradFi with the transparency and the 24/7 availability of the blockchain. The mission is all about stable, real-world yield in an always-on environment.
Which brings us to their two main products, OUSG and USDY. Let's start with OUSG. What is it?
Yeah. OUSG is the Ondo Short-Term U.S. Government Treasuries Fund. So it's a tokenized fund that gives you exposure to short-term U.S. Treasuries.
Okay, simple enough.
But the key detail, and this is really important context, is how it gets that exposure. It does it by investing through BlackRock's own institutional digital fund, BUIDL.
Wait, hold on. BlackRock, as in the $10 trillion asset manager, BlackRock. Why is that so crucial?
Because it screams institutional legitimacy. It de-risks the whole custody question. When you partner with a behemoth like BlackRock, you get layers of security, regulatory confidence, and massive liquidity access that some small crypto-native firm could only dream of.
So OUSG is really built for the big players, for institutions to use as collateral.
Primarily, yes. And then you have the other product, the one that gets a lot of the attention, USDY. The U.S. dollar yield token.
Which sounds a lot like an interest-bearing stablecoin.
That's a great way to put it. It's backed by a mix of short-term U.S. Treasuries and some bank deposits. It's built to stay stable while offering these very steady returns, usually around 5% APY, give or take.
And the value here seems massive. You're talking about institutional-grade, low-risk returns that are available 247 to global investors. The sources show Ondo is just dominating this space.
They are. They have somewhere between 25 and 40% of the entire tokenized U.S. Treasury market. Over $1.5 billion in value locked.
That's a huge first-mover advantage.
It is. But as you said, the biggest benefit is that 247 access. For users in, say, Latin America or Southeast Asia, where you have serious currency instability, I mean, having a yield-bearing, dollar-pegged asset that never sleeps, that's a lifeline for preserving capital.
But this incredible global access comes with a giant asterisk, a huge blind spot, right, for listeners here in the U.S.?
Yes, this is a big regulatory hurdle. Because the SEC's stance on these things is so unclear, Ondo Finance completely blocks access.
So to be clear, USDY and OUSG are not available in the United States.
Or to U.S. persons, correct. Their whole growth strategy right now is focused outside the U.S. until the regulatory picture gets clearer here.
That's a massive carve-out. Okay, before we move on, one last little detail on yield. I saw mention of ROUSG for people who want the token price to just stay at $1.
That's right. It's the rebasing version. So instead of the token price creeping up as yield is earned, ROUSG just stays pegged at $1, and it pays you the yield by giving you more tokens every day.
Ah, an accounting trick, but a useful one for certain protocols.
Exactly. For things that need a stable dollar collateral value, that $1 peg is what you want.
Okay, so we get the products, but they're kind of useless without a safe bridge to the real world. How is Ondo actually building this this compliant infrastructure. You called it a financial translator.
I think that's a perfect way to look at it. It all starts with custody. The actual treasuries aren't held by Ondo. They're safeguarded by licensed institutional-grade custodians. Think Fireblocks, Zodia custody. The token you hold is a legal fractional claim on those assets.
And the compliance piece is baked right into the tech.
Right into the smart contract. They use a custom token standard, OST20, that has automated KYC and AML checks built in. It means only pre-approved, whitelisted wallets can even touch the assets.
But that creates friction. I mean, I read about this 40 to 50-day transfer delay for USDY after you first mint it. 50 days. In crypto, that's an eternity.
It is. And that's the necessary friction of building a compliant bridge. It's a regulatory guardrail.
To stop money laundering.
Exactly. It satisfies rules that require a holding period before an asset becomes freely transferable. It's the price you pay for institutional buy-in. Once that period is over, it's $247. But that first step is non-negotiable for them.
Compliance first, efficiencies second. Got it. Now, under this whole Ondo umbrella, we have Flux Finance. How does that fit in?
Flux is absolutely crucial. Think about the traditional repo market where banks lend and borrow against treasuries.
Right, but those markets close. They shut down overnight.
Exactly. Institutions face what's called overnight risk. Your collateral is locked up. Flux Finance solves that. It lets you use tokenized assets like OUSG as collateral to borrow stablecoins on-chain.
24 hours a day.
7 days a week. It creates an always-on borrowing market. It completely eliminates that overnight counterparty risk, which is a huge deal for capital efficiency.
A genuine improvement on traditional finance. So let's look ahead. They're building a whole new house now. The Ondo chain. If the whole point is to bridge to Ethereum, why build a separate layer 1?
It's not to replace the bridge. It's to prepare for institutional scale. The public chains are great, but big institutions demand specific features that a public chain just can't offer.
Such as?
2 big things. First, permission validators. Only approved institutions can run the network, which maintains a high level of trust. And second, specialized tooling for settlement. Specifically, something called atomic delivery versus payment, DVP.
Atomic DVP. Okay, break that down for us.
It's the gold standard. It just means the asset and the cash swap hands at the exact same time in one single transaction. There's zero risk of you sending the asset and not getting the cash.
So no counterparty risk at all?
None. And if you want to settle trades for major banks, that feature is absolutely non-negotiable. That's why they need their own chain.
That makes a lot more sense. Okay, Before we get to competitors, let's just hammer this home one more time because I think it's the most confusing part for new investors. The Ondo token versus the products.
Yes, this is critical. The Ondo token is a pure governance token. It lets you vote in the DAO. That's it.
You need 1 million of them to even vote. Right?
Yes, you do. Crucially, holding the Ondo token does not give you any claim on the revenue or the yield or any of the underlying treasuries.
So holding Ondo is a bet on the platform's growth, not a way to earn yield yourself.
Precisely. If you want yield, you have to buy and hold the products. USDY, OUSG. Holding the Ondo token is a purely speculative bet on the ecosystem's adoption.
That clarity is so important. Okay, let's pivot. How does Ondo stack up against everyone else? Because this RWA space is not a winner-take-all game. It's more like a battle of ideologies.
That's a great way to frame it. You have these different architectural philosophies emerging. Ondo's is what you might call the yield bridge.
The yield bridge.
They focus on threading low-risk, institutional yield into existing public chains like Ethereum. They're all about composability.
Okay, so what's another model? I saw Securitize mentioned a lot.
Securitize is the institutional fortress. They have SEC and FINRA licenses. They operate in a completely closed-loop, permissioned environment. They are not trying to play with open DeFi.
It's blockchain rebuilt for Wall Street's comfort zone.
Exactly. Maximum compliance, minimum composability, a lockdown VIP club.
And then you have the dedicated chains like Plume Network.
Right. Plume is the compliance native L1. They're building a chain where the compliance rules, the KYC-ML stuff, are coded directly into the base layer of the protocol.
So instead of a wrapper, compliance is the air the assets breathe.
The perfect way to put it. They're aiming for regulated composability within their own ecosystem.
And where do players like MakerDAO or BounceBit fit in?
Maker is the DeFi veteran, but their stablecoin DAI is mostly backed by crypto collateral, which means it carries crypto liquidation risk. BounceBit is a hybrid, a CDeFi model. They use centralized custodians, but their yield model is way more complex. It's like coupon plus on-chain alpha. They stack yields, which offers more return, but also way more complexity.
So Ondo's main advantage is its simplicity and that top-tier asset quality.
It is. The focus on U.S. Treasuries and that BlackRock connection is their killer app right now. They chose the safest, most boring, most universally accepted collateral asset in the world. And in finance, boring is often very, very good.
It's clear every model is making a different trade-off. But let's talk about the headwinds, the risks. What challenges does Ondo have to navigate?
Well, the biggest one remains regulatory uncertainty. We talked about the U.S. problem. But the most immediate binary risk is the SEC's pending decision on the 21 shares Ondo ETF filing.
Binary risk, meaning it's either a huge win or a huge loss.
Exactly. If it's approved, that's massive validation and market access. If it's denied, it confirms just how hard it is to bring these assets to U.S. public markets.
And even globally, it's not smooth sailing.
Not at all. You have places like Hong Kong that are really embracing this stuff. But the global inconsistency, the lack of clear frameworks, really slows down cross-border adoption.
Okay, let's turn from external risks to internal ones, the Ondo token's supply schedule. The sources basically painted this as a ticking time bomb.
It is a major variable. Over 85% of the max supply is still locked, and insiders and institutions control something like 98% of it.
That's incredible concentration.
It is, but the main concern is the vesting schedule, the unlock dates.
Give us the dates.
January 2026, January 2027, and January 2028. On each of those dates, a colossal 1.71 billion ONIDO tokens are scheduled to be released into the supply.
A huge supply shock 3 years in a row. What does that mean for an investor?
It means the platform's growth and market demand have to be big enough to absorb all that new supply. If the market hasn't grown fast enough by 2026, well, you introduce a serious risk of price dilution for anyone holding the token. Those are dates circled in red on every investor's calendar.
And finally, the competition is not standing still.
Not at all. Ondo proved the model works, but now the giants are waking up. JP Morgan, BlackRock.
Yeah.
They can just launch their own competing products. And you have crypto natives like Ripple and Goldfinch moving aggressively into other RWA areas. The validation brought the competition right to their doorstep.
This has been an incredibly thorough deep dive. We've seen how Ondo Finance is operating right at this convergence point between institutional finance and DeFi.
And the key takeaways for you are pretty simple. Ondo is using top-tier assets and partnerships to deliver stable 247 yield to a global audience. And just remember that critical distinction. The Ondo token is for governance. The yield is in the products like USDY and OUSG.
Absolutely. And we've seen how these models have to deal with compliance. It's either external, like Ondo's Bridge, or dominant, like Securitize's Fortress, or native, like Plume's L1. But this raises a final thought. If that compliance problem can eventually be fully solved through code,
if the rules can be perfectly, programmatically embedded into the blockchain itself, making the whole process self-enforcing,
rather than needing layers of expensive human intermediaries,
then you have to ask the biggest question of all for the future of finance. Will this movement eventually make traditional intermediaries, brokers, asset managers totally obsolete? The entire job of so many people on Wall Street is managing compliance. If a smart contract can do that job, the entire structure of finance could change forever. That's the true scale of the revolution we're watching unfold.